How do you like your toast? This is how I like mine. Toast is actually a tech stock, up 82% this year alone. Just take a look at their revenue growth, up 32% year over year for the past year. That is insane. So, you might be asking, what is Toast? What do they provide? Well, picture this. You're at a restaurant and you ask the waiter for a bill. The likelihood is they will return with a Toast card reader. These are what are called point of sale systems, or POS systems for short. Essentially, you tap your card onto the card reader, it runs through Toast software and hardware, and for that, they will take a percentage cut of the bill. So, what makes them different from any other point of sale system, like Lightspeed or Square, for example? Well, the difference is that Toast is highly focused on the restaurant industry, whereas Lightspeed and Square and other similar point of sale systems, broad scale for many different types of businesses like barbers, catering, convenience stores. Essentially, this gives Toast an advantage because they can really fine-tune their software to restaurant-specific needs. Toast's focus on restaurants has meant that it can craft an array of software for the restaurant industry. You know, if you have a look here, you can see a range of different businesses, from cafes to pizzerias to food trucks, and they've got every single type of software available for you. I mean, think about a pizzeria, just how many moving parts there are. I mean, this software encompasses all of that and, you know, covers that for you. And really, Lightspeed and Square don't offer anything like this. I mean, they have very basic restaurant softwares, but nothing that is as fine-tuned as what Toast provides. We can see here that Toast is providing a software for casual dining. You see how this shows the dining room, all the tables at the dining room, and all the orders on each table. It puts it all neatly onto one software that maybe front of house can view very easily. You know, they're not going to mess up their orders now. This array of restaurant software all fits together nicely with the point of sale system that we talked about earlier. All of this happens through the cloud, and it allows restaurant managers, front of house, you know, kitchen, all to communicate extremely smoothly. It creates unmatched restaurant efficiency.
Two beef!
Okay.
One halibut, one fucking John Dory!
There's one, so you need one more.
I want them together!
Okay.
I want you to communicate with each other!
Okay.
So I just wanted to show you some of the hardware and software that Toast actually offer. So for the front of house, they've got the standard point of sale system that you'd use at the till if you went up to the till. Pretty sure that this can rotate so that the customer can look at the screen and then pay the bill. And obviously you've got the handheld point of sale. This kind of allows waitresses and waiters to walk around with the billing machine, as well as place orders through the handheld point of sale system. Then you've got the kiosk. So this is like self-service. Obviously that, like they say, reduces wait times and labour costs. Then you've got, you know, mobile order and pay, and the reservation and wait list. You know, this dramatically helps the front of house because they don't need to try and remember what order was for what table. Moving on to back of house, we have the kitchen display system. This allows chefs to easily keep track of what order's been placed, when it was placed, and you know what ingredients they'll need, how quickly they've got to get it out. You know, it really just helps them keep track of that. Not only that, but it really speeds up the process of a customer getting their food, because as soon as order is made through the handheld point of sale system that we've got up here, the chefs can be cooking almost straight away. It'll go straight through to the kitchen display system, and yeah, they'll be cooking.
I can see what they're doing, what he's doing. I can see it, I feel it. He's cooking.
Moving on, they also provide things like online ordering and gift cards. when it comes to the back of office and team management, they provide rota management. Then the reporting and analytics side of the business obviously is great for restaurant owners. They're going to be able to see data that they need to improve their business. Also, they offer multi-location management or management.
Spell red.
Red, L-S-T-E-R.
So how does all this really provide value to the customer? Well, I'm going to show you a clip here from a few of the people who are using their software. Just bear in mind that this is Toast's own promotional video, so take it with a pinch of salt. Without further ado.
My name is Corey Neal. I'm the general manager here at Potback in Austin, Texas. We are a seasonal farm to table restaurant. 100% of our menu from top to bottom is sourced locally. After we got comfortable with the set amount of tables that we had in the restaurant, we were looking to kind of push out to a cocktail area. So we started looking into mobile POS devices. Aloha was a little pricey. When we were asking them to switch to handheld units, it was expensive. Before we had Toast Go, we were losing a lot of people on the way. As far as wait times go, typically for a table of 2 on a Friday night, we're anywhere from an hour and a half to 2 hours. With Toast Go, we have found that our turn times essentially for every category drop anywhere from 30 to 45 minutes per table. And now that we're using Toast Go, we're running about an extra $30,000 a month in sales, which when you kind of multiply that out, equates to an extra $500,000 a year in sales.
This is essentially how Toast has impacted 2 Michelin star restaurants.
We are fortunate to receive a Michelin star. Love Toast kitchen screen, especially our chef Andrew. It has really helped organize all the orders, especially with Proxy being more fast-paced, having all the orders on display with color codes based on length of time. It definitely creates a more efficient system between dining room and kitchen.
Cooks, for all of their wonderful qualities, don't always have the greatest memories. And one of the features that I like a lot is being able to pick up it all day on everything that any given cook is asking me for. So as opposed to hunting through tickets and tallying it all up in my head when we're very busy and I have a lot of other things to do, I can just hit a button and it's right there for me.
So you get the point there, really. Toast as a business is saving other businesses, restaurants, money by speeding up their efficiency and just creating more time for the workers and giving management a lot of data and analysis. Okay, so how does the business generate revenue? So their hardware brought in about 53 million in Q2. Their fintech and point of sale systems brought in just above $1 billion in revenue in Q2. And their software suites brought in about 166 million in Q2. So this kind of gives you a grasp of just how much revenue they make through the fintech and point of sale systems. Their hardware usually loses them money and is more of an onboarding system to get the restaurant owner to become part of Toast's ecosystem that uses all of the software. So you can see here that their hardware only generates 53 million in revenue in Q2 and it costs 96. So they're losing about 43 million per quarter here. On the software side of the business is where Toast actually has a larger margin of about 65 to 70%. Essentially, the point of sale system is also an onboarding process to get restaurants to upgrade to the software, and therefore Toast can make higher quality revenue with a lot higher margins. With the point of sales and fintech side of the business, they have a gross payment volume of around 140 billion US dollars. This essentially means that Toast's point of sale system process over $140 billion per year of restaurant bills. So when you were to pay the bill and you paid £40 to the restaurant, that processes through Toast and counts towards the gross payment volume. Now of that, Toast hold back 2.69%. I thought I'd show you Toast's website here because it's easier to visualize what kind of percentages Toast hold back and what kind of fees they charge. So for a check size of about $100, they would hold back £2 or $2.69, and they only take about 77 cents of those $2.69. The rest of that money goes towards other processing fees like MasterCard and Visa. So because they hold back about $2.69 and they keep about 77 cents of that, their margin in this area of the business is about 28 to 29%. So the software is what makes Toast the highest margins. It's also what offers the most value to the customers. This all kind of links into Toast's strategy to onboard their customers onto the software system and therefore make a higher margin. If the software is saving restaurant owners a lot of money,
$500,000 a year.
then restaurant owners are going to be happy to pay premium prices for that software, as long as it's still saving them money. So this has led Toast to be able to increase the prices of their software by almost 50% from 2020 to 2023. Now, I think there's still room in there because I still think that it's giving restaurant owners a lot more value than they're paying for. So I wouldn't put it past Toast to have price increases over the coming years. This will, of course, increase their margins. The CEO, Aman Narang, was asked whether his business was a software business or a fintech business.
Question for you. Totally not what I was going to ask. Is Toast a fintech business or a SaaS business?
I think it's both. It's definitely both. I mean,
If I were to force you to be one.
customers care deeply about our software. That's why they picked Toast. Found it fundamentally. So maybe that's what I'll say.
But it's a great business because it's a fintech business.
I think the two together are complementary.
This is why Toast has such an advantage over Lightspeed and Square in the restaurant sector. Lightspeed and Square might have basic restaurant software, but they don't have that highly specialized software that Toast has developed over the years. I just wanted to show you guys the fundamentals. So Toast is currently trading at $31. Its price to earnings ratio is actually currently negative because the company is not profitable as of yet. However, it's moving very swiftly towards profitability. You see its forward PE is 41 here. So its free cash flow yield is actually positive, but it has a negative stock-based compensation adjusted free cash flow yield, and that's really what we should be looking at, because you've got to factor in stock-based compensation. What the employees get paid in terms of stock is still an expense and should be accounted into that. So obviously you've seen the price chart at the beginning of the video. This is what it looks like over the 5 years. It actually IPO'd really high, totally overvalued at this point. Had a drop off, that was in 2021, had a drop off and then kind of hovered around the 10 to 20 mark for about 2-3 years. And now recently, obviously from around a year ago, it's just climbed in price. And that coincides with its turn from rapidly decreasing free cash flow to rapidly increasing free cash flow. I mean, look at that chart there. That has gone from rapidly in the negative, to rapidly positive. And this is what I think is going to drive some of the company's growth over the next couple of years. So what's really astounding about this company is just how fast they can grow their revenue. So trailing 12 months, year over year, we're looking at 32%. So it's gone from 12 months ago, 3.32 billion, now at 4.39 billion. So over the 2 years, it's actually grown even faster, at 40% per year. This revenue growth is really what's pushing the stock price up at the minute. When we look at the EBITDA, we notice the same thing, just rapidly trending towards profitability. It's only 21 million away. I really think this is a good sign for the stock. One thing that I'd like to mention about the free cash flow is, although the free cash flow growth looks insane, when you take into account stock-based compensation, the stock-based compensation is still quite a bit higher, about 90 million higher than free cash flow. This obviously means that when you adjust it, you're still bringing in negative free cash flow per year at about 92 million. As Toast becomes more profitable, we should see this trend continue, and that's why I'm quite hopeful about the stock. When we take a look at their balance sheet, you notice that they've got a whole load in cash, not much debt. Brilliant. Here obviously is one downside to Toast stock, is they are still diluting the shareholder. There was obviously quite a big dilution last quarter, which sucks. Did want to show you the gross margin. It's going up over time, and I think that this will continue to rise. It's quite low because of what I showed you earlier with the point of sale system having quite a low gross margin. Obviously for a tech stock, usually you're looking higher up in the 50, 60, 70% in the case of Microsoft and Google. Another bull case for the gross margin increasing is that Toast has actually recently increased its credit card processing fee price by 0.22%. So I think that this should increase margins. So this increase in processing fee started this September. That probably means that we won't see the results until Q4 results are released. So Q3 results are going to be released tomorrow. I'll probably release a video on that. And in Q4 as well, we'll probably see the larger gross margin increase. So the credit card increase of 0.23% brings the price and the payment processing fees to about $2.92, and now Toast will keep $1 of that. So what if we were to hypothetically add the credit card fee increase to this Q2 result? We would see net income sitting around 100 million. I will show you how I've got to this calculation. So by my basic calculations, that should add about 8.5% to the financial technology solutions section of the revenue. This will increase gross profit for Q2 by about 30%, bringing it to around about 374 million. So rather than that. That means that if we had applied this increase in Q2, we would have had a net profit of around 103 million instead of the 14 million that we have at the minute. Like I said, we should actually see this come into effect in Q4 for Toast. If we were to expand this out over the year, we'd be looking at 412 million in net income just based off of the Q2 results with the credit card price increase. Another reason that I think that the gross margins will continue to expand is because of Toast's pricing power when it comes to software. Once a restaurant is ingrained into using that software, they do not want to move. I mean, you've seen how much more money they are generating using Toast software. I think that they're going to be happy to pay an extra $20 a month, an extra $50 a month, an extra $100 a month. At the minute, their software charges are only like 100 to 200 to 300 pounds a month, dollars a month. I think as Toast continues to get restaurants to buy add-ons to their software, their margins are going to increase. Analysts and Toast themselves predict that Toast will be profitable by the end of 2024. I do believe that Toast will be able to keep their revenue growth extremely high. I wouldn't be surprised if it slowed down a little bit. That does seem to be the trend, a mild slowing down over time. So can Toast's growth continue? Well, Toast claims that they have a 13% share in all US restaurants. They currently have 120,000 restaurants using its services. And like I said, they claim that they've got plenty of room to grow. They're saying that the total addressable market in the US is 175,000 US restaurants that they can tap into and make money with. The issue with what they have to say is that this number likely includes larger quick service and that this number likely includes larger quick service and franchise restaurants such as Chipotle or Burger King. Toast finds those companies a lot harder to penetrate, mainly because they have their own custom software. definitely give up. Why was I even trying to write that though? So Toast claims the 875,000 restaurants are all within their total addressable market. However, in reality, the National Restaurant Association has estimated there's about 349 chain restaurants and over 156,000 single location full service restaurants. So if we take 120,000 of those away, because Toast already hit those, then we're only looking at around 380,000. This still means that Toast can effectively quadruple in size if they play all their cards right. And that's only within the US. They are also expanding globally. So they currently have 2,000 live locations internationally, and they've moved into Canada, the UK, and Ireland. They're saying that the global restaurant total addressable market is 1.15 million. Like I said, they're overestimating a lot here. Take that with a pinch of salt, but I think that they definitely can expand outside of the US, and I think that this is a positive for Toast and Toast stock. I think that growth stock will continue to rise higher into next year and the year after. The company claims that it's aware of the fact that it's giving out too much stock-based compensation and initiated some stock buybacks at the beginning of this year. So I expect them going forward to have a bit more control over their stock-based compensation, which also will benefit their free cash flow. I do want to address some potential bear cases, so negative cases for the stock and stock growth. I've seen a few articles that talk about how Toast is completely reliant on the restaurant industry and how recessions really affect the restaurant industry's sales and growth, and that for this reason Toast is a risky stock to buy into. Now, I wanted to show you guys something. This is the revenue chart for Darden Restaurants. So this is a publicly traded stock that has over 3,000, 4,000 restaurants in the US. Anyway, spot the recession. So we can actually see it. It's right here. 2007, 2008 recession. Now, what baffles me about this is that the recession quite literally affected them for 1 quarter, and their revenue is straight back to normal following this line here. So this big talk about how recessions are going to wildly affect restaurants, I just don't think that's true. I do believe that people are always going to come back. They're always going to come back. I mean, and in this case, it only took 1 quarter to get straight back. I do have a clip of the CEO, Aman Narang, when he was asked about recessions.
Versus the next year or two.
Do you worry about recessions? And what I mean by that is your business obviously depends on consumer spending and transaction volume in large part. You have consumer budgets hit and they don't spend as much.
Not as much, because if you think about, we went and studied some previous recessions, and what you see is restaurants are largely very resilient because people love to go out to eat. And so, yes, there may be some, shifting in terms of shifting from FSRs to QSRs, or there might be a little bit of shifting, but it's not dramatic. And, one of the things that's great about Toast is the value proposition is about efficiency. It's about how do you do more with less. It's how do you turn the tables faster? How do you drive incremental demand through online ordering channels? That's cheaper. The value proposition in some ways is actually stronger when things are more challenging.
So another bear case is that AI will allow for easier software creation, so it will allow for more competition in these markets. The issue that I have with this is that it's not like Toast will not use or have AI of its own that they can layer on top of their platform. It's not like they won't be able to use AI to create a better platform. They've already got first movers advantage, and I don't think that they will lose that easily. The last bear case is the question, is there enough runway of growth within the restaurant sector? I think this is a difficult question because I definitely think that they've got 5 years worth of growth in them in just the restaurant sector alone. If they are able to expand internationally, they'll definitely have about 10 years. A lot of people note that the cultural differences means that when companies are transitioning internationally, they can find it very difficult. And I just hope that Toast's business model is applicable in Europe. So I want to have a look at the valuation of the stock now and what I think it's worth. But before I do that, I just want to show you this slide from the investor presentation. I'll obviously take this with a pinch of salt because it's coming straight from Toast's investor presentation, and they're going to be very positive about themselves and what they think they can achieve. But essentially, they are saying that they can achieve 30 to 35% adjusted EBITDA as a percentage of recurring gross profit streams. So this doesn't take into account the selling of hardware, it just takes into account the fintech point of sales and the software side of the business. I'd like to share with you my valuation scenarios. I use a site called Qualtrim to generate scenarios. Basically, it's just a discounted free cash flow model with a few different inputs. So I have two different scenarios. I have one with lower margin expansion and one with higher margin expansion. So for this scenario, I have lower margin expansion. I've said that revenue growth over 5 years will decline to 15%. I understand that this is still quite rapid growth. I just do think that there is enough growth room for Toast. I've got the margins at 7%. So the predicted margins for the fiscal year of 2024 is 5.73% or around there. So I've predicted that over the period of 5 years, margins will move towards about 7%. And I've also predicted that revenue will grow at 24% in 2025, 19% 2026, 17, 15, 15. So it's a slow decline towards 15%. So here are the results from the lower margin scenario. Here we have the free cash flow yield at the bottom. I predict in the future that Toast will probably trade at a free cash flow yield of around 2.5 to 3%. So to be honest with you, if Toast fails to increase their margins, then at the current price of $31 per share, I do not think that this is a viable investment. So here with the higher margin side of things, we have the revenue growth I've kept the same, and the margins have increased from 5.73% to 10%. I understand this is a big difference, but I do believe that Toast can achieve this, and they are predicting quite large margin expansion themselves. So if we have a look at the results of this, if Toast trades around a 2.5 to 3% free cash flow yield, you will probably receive above market returns over the next 5 years, 12.94% if it trades at 3, and 17.14% per year if it grows. Now, don't take these numbers as gospel. They're more of an estimation. I actually bought into the stock around $27.9, so around here. I bought into the stock hoping that the stock would dip a little bit, in which case I could buy more. However, it has just raced up. I won't be purchasing any more Toast stock until it falls down between $28 and $26. This is definitely one of the riskier plays in my portfolio, and I hope that it gives me the growth that I'm looking for. Please let me know your opinions on the company in the comment section below. Tell me what you think of my valuations. Are they spot on, or are they a little bit far-fetched? Here is the rest of my portfolio. Toast now makes up about 4.13% of my overall portfolio, and to be honest, I don't intend to make this any larger than 5%. I have 13 holdings, some a lot more concentrated than others, and my high concentration into a few companies is what I think will provide me with market beating returns. As I was recording this video, Q3 results came out and the price of Toast shot up to around $37.50. I'm now up 26% on my original investment. If you want to know more about the stocks I've invested in and hear in-depth reviews of certain stocks and companies, then please click the subscribe button. Subscribe, boys. Come on, do it.